This is the Harness Money Report, a show designed to help anyone become a better investor. Every week, your host will break down a stock from beginning to end, the management, products, revenue, future, and so much more, all leading to the final stock verdict. Are you a bull or are you a bear? This show is for information and education only. Please do your own research before making any financial decisions. Thank you for being here, and now here is your host, Colin. Welcome to Harness Money. My name is Colin, and I have a great show planned for us today. We are going to talk about our very first small cap stock. So this was a brand that I had heard of but had never really explored before, and today's show is going to be all about NerdWallet. So every single week I tried to take one company and break down everything about the business, about the stock, and then finally I will give you my verdict. So today we are going to discuss NerdWallet, and as you can surmise from the name, NerdWallet is primarily focused around personal finance. It's a personal finance platform that is really trying to give you as much information about finance as possible to make your financial life better. So let's jump right into this. The ticker symbol for NerdWallet is NRDS. It is priced right now, the stock price is about $10.50. So pretty cheap stock price, and they are headquartered in San Francisco, California. So this is the very first Silicon Valley stock that we have really talked about on this channel so far. So I'm very excited to jump into this. And as I mentioned, NerdWallet, a little overview is that it is a personal finance website, and now it has an app. They have launched an app that provides you with content in the form of articles, videos, advisors, financial tools, personal finance resources like savings accounts, calculators, and they also provide products. So they provide links to products. So the number of employees, right now they have 730 employees. So not a huge employee count, which is probably a good thing for this business because since they are located in San Francisco, employees are not cheap in that part of the country. And they're very savvy being in the tech space of what to expect from working in that sector. So keeping that headcount down is probably important for just the costs, the operational costs of this business. So I would watch that closely going forward to make sure it doesn't dramatically increase in the near future. So how does this business make money? So that was the really interesting part of this business that I had not seen before, which is that they primarily make the vast amount of money from affiliate marketing, from receiving a kickback from all of these different brands. Whenever they recommend a credit card or a bank account or some type of financial product, they receive essentially a finder's fee for you doing that transaction. And that is primarily the way that they make money. They also make money from advertising as well, some of that, but the majority of their money comes from affiliate marketing. So who is the target customer for this business? Well, NerdWallet is focused on many different types of customers, but you can imagine that the original type of customer was a young adult or a millennial. So they are primarily focused on individuals that are online. Pretty much their entire business is online. So they're focused on a little bit of a more savvy consumer that's looking for financial information, professionals, individuals with debt, small businesses. They've recently incorporated that segment into their business. People that are financially literate and want to be financially literate, and people that are looking to travel. So those are the target customers for this business, but they really cast a broad net. They're providing some basic financial information that people need to check their financial health and then improve their financial health. But they're also lasered in on those credit card offers. And so that's a pretty specific consumer that's looking to get the credit card bonuses, that's trying to find the best credit card to meet their needs. So let's talk a little bit about the history, because the history of a business is important. Some businesses are over 100 years old, like Allstate or Coca-Cola or banks. But this business was founded in 2009, so it is truly a young tech company, and it is in growth mode. So 2009 by Tim Chen and Jacob Gibson to provide consumers with practical financial information. And it was originally started as a spreadsheet to compare credit card offers. So really founded as a way to solve a problem. And there are a few different tools that do this out there that really aggregate all these credit card offers and then try to provide you with the information to pick the very best one. So Tim Chin was a former hedge fund analyst, and he was the one that started NerdWallet after having difficulty comparing credit card options. So he started it with an initial $800 investment, and he created a simple spreadsheet and then offered that online to his audience. Jacob Gibson, for a long time, his partner was the chief operations officer before he went off and started his own venture capital firm focused on fintech called Better Tomorrow Ventures. And the website was officially launched in 2009 of this business. And that is primarily the launch vehicle today. The primarily wheel of this business is the NerdWallet website. So in 2010 and 2011, they expanded their content to include products beyond credit cards, such as banking and investments accounts. So really today, the whole strategy of this business has been to expand the number of products that they receive an affiliate marketing amount from. So expand the different lines of business that you can compare products, whether that be small business, banking, credit cards, travel, all that. They have really tried to encompass as much as possible into their website where you can comparison shop different products. So 2013 to 2017 was really about engaging customers, trying to reach as many customers as possible and get them coming to the website and then get them engaged in their product. So in 2014, they boasted having over 30 million unique users on their platform, which has allowed, so this expansion and just reaching sheer volume of people has allowed them to, number one, get more customers in their funnel, and number two, allowed them to also do advertising. They are able to advertise on their business and make money through that revenue source. 2014, that was when they introduced the travel resources to their website. 2015 was really about expanding into a range of financial tools and calculators that are included on their website now. So I think going forward, the future of this business, part of it looks like being the primary source to get a snapshot of your financial life. So your net worth, what products you have, what your credit score is, all that information, aggregating that into NerdWallet. So 2016, they did a Series A funding and they raised $64 million along with a venture capital partner, and that valued the company at $500 million. So in 2016, they were valued at $500 million. And that was also the launch of their mobile app. So in 2016, they were able to launch the mobile app on the iPhone and the Google Play Store. 2017 was really about expanding their team. So now that they raised money, they're putting it to work. So expanding the content team and expanding their engineering team to build the right tools. I'm sure create a better roadmap for their financial website, their product, just all of the things that they offered. And they also did a rebranding. So they changed their logo and just did a little bit of tweaking with their brand to make it realigned with the clarity in providing financial decision making for this business. So they really wanted to be a more holistic approach rather than just comparing credit cards to determine which one was the very best one. They want to be a more holistic, more comprehensive platform to figure out your financial future. So They position themselves as the leading personal finance website with millions of monthly users. And then the big shift for this business was COVID. So 2020, we all know what happened during 2020. The world shut down, the stock market tanked, the government stepped in. So I really think during this time, it benefited this business in a few different ways. So not good that people were getting laid off, but that did give more people time at home to scroll on the web, to find out more information. When people get laid off or there's turmoil, people are generally looking at their own personal financial situation more, and that in turn leads to finding the NerdWallet website, their information, their products, all of that good information. So 2020, they also acquired a business called Fundera, which allowed the business into the small business loan marketplace. So that was a big step for them into getting into the business world. Small businesses, which lead to large businesses, and just there's a lucrative market for small businesses. Often have cash flow problems, or they need short-term loans in order to bridge a gap between their sales and their accounts receivables. So there's a market. There's definitely a market for small business services, loans, financial products, banking accounts, all that good stuff. And small business accounts in general are a little bit more lucrative or they can be a little bit more lucrative than consumer accounts, because usually with a business, you're doing more transaction. There's transaction volume through bank accounts, through credit cards, things like that. You're constantly buying materials, buying supplies, paying your employees, getting payments from customers. And so being able to provide services to that specific segment could provide more revenue for the NerdWallet business. So what happened in 2021, what also made this very important, is that they went public. They did their IPO in 2021, like so many other businesses in the United States. They took the opportunity to raise money and take it public. The most notable that I'm thinking about that had a big splash was Airbnb. Airbnb went public during the pandemic and raised a lot of money and had a successful IPO. And this one was no different. They took the opportunity with the market open and optimism that we were going to get through the COVID crisis, that they went public. So they went public on the NASDAQ on November 4th in 2021, and they began trading at $28 per share. But spoiler alert, the business has not surpassed the stock price of $28 per share since they went public. But I do find it interesting to note that they went public on the NASDAQ. So many technology companies go public on the NASDAQ. It's important to keep an eye on that exchange, because when that exchange moves, pretty much every market in the world can move because of that market. So I always just find it fascinating why one business decides to go. It doesn't really mean much in terms of people investing into that company. If you're on the NASDAQ or the New York Stock Exchange, I would say the NASDAQ is a little bit more tech-centric, and the New York Stock Exchange probably just has that historical value, seems a little bit more proper and just more traditional with Wall Street, so might have a little bit more of a cozy relationship with Wall Street. But the NASDAQ is much more tech focused, and tech companies have gone crazy with their valuations. So the biggest companies in the world are tech companies, so you cannot discount the NASDAQ. And it really doesn't make a difference which one that a business decides to list on. I just like to track which businesses are on which exchange and so forth. So 2022 is really about expanding internationally. They are trying to reach other consumers in other countries with their products. And I really think that is the future of this business, is to, of course, get more engagement at home, try to provide more products in the United States and to the maybe Canadian marketplace, the US marketplace, capture as many of those people as possible, because this is one of the most valuable marketplaces in the world. We have so much more money than most places in the world. But there is a lot of opportunity internationally, specifically in Europe. I think that NerdWallet could capture consumers and really just provide more products. I know it is a different in the European Union and in Asia. Affiliate marketing is a little bit different. It's maybe not as lucrative as it is here in the States, or it's a little bit more regulated over in those markets. So that's something to keep an eye on. But I do think that is the future of this business, that they need to capture as much individual consumers internationally as possible for this business to really take it to the next phase of their growth. Also, in 2022, they launched NerdWallet Plus, the NerdWallet Plus program, which I really think is the future of this business, and they're really trying to make this a core driver of revenue, which is their rewards program, their membership program. So you pay money to be a part of this program every single year, and you get rewarded. So if you do a certain number of actions every year, you get rewards, and that could be cash. That could be a rewards in the form of cash back. So there's a lot of emphasis on pushing the NerdWallet Plus program, which it just leads in general to businesses and membership programs. It seems like there is a huge trend for businesses to have a membership program, to be growing their membership program, and just try to offer as much as possible with those programs as possible. And I do understand why. If you have a rewards program like Starbucks or like Costco, people love those rewards programs. They're very involved in those programs, or they have a lot invested into those programs. It just engages your consumer that much more. And another reason that this is important for this business is because that is really, they are looking for the membership program to be the hub of your financial wealth, a snapshot of your financial wealth, your financial health, and then they can recommend products to you. So you're going to track your net worth, you're going to get your credit score, and then you're going to get offers for products that you may need in your financial life, as well as probably articles and information that could help you in your situation and going forward. So there are lots of different financial products that they still could explore integrating into their businesses, which I'm thinking of as cryptocurrency, maybe health savings accounts, investment accounts, just all different kinds of that. Financial services planning, small businesses services, which they've already really jumped into for their business. So it'll be interesting to see how they develop this platform going forward. They really have integrated a lot already, and they haven't gone crazy with acquisitions either. They haven't spent too much money, which I like to see. I don't like to see too many acquisitions in the beginning, or if they do make an acquisition that's large, they have to have a very compelling reason for it to be acquired into the business. So let's talk about their products and services that they offer to their consumers. Their products are really affiliate links or affiliate commissions on the products. So that's one of the more less desirable aspects of this business that I'm not necessarily a fan of, which is that this business, they pretty much offer credit cards, travel credit cards, consumer banking services, small business loans, personal loans, home loans, insurance plans, and then they receive a kickback. They receive a cut for that transaction, for someone making that transaction on the website. The problem with that is that I don't really see anything compelling or anything really proprietary about their products that someone else couldn't replicate. So if you are a Bank of America or JP Morgan and you're offering a credit card, you could easily pull your offers from NerdWallet, I feel like if there was some type of reason that the bank felt like they didn't want to provide their products or services to NerdWallet, I feel like the bank could do that. They could just pull their business and not allow this business to offer their products. So that's the part I don't like, is that they don't actually have the product that they're selling on their website. They're just providing information. They're providing the offers from all of the other providers, which really becomes a problem down the line. If you're dealing with many vendors and one of them gets mad or one of them decides they don't want to work with you, they don't have to. They can easily pull their product, and there's not much you can do from their point of view. So that is the primary way that they make money, is through commissions, through offering all of the various financial products and then taking a finder's fee for offering the product. The other thing I don't like is, let's say you're using NerdWallet to compare credit cards. You've looked at 5 different credit cards. You don't have to sign up for that credit card through NerdWallet. You could take all of that information and go sign up on the provider's website, the bank's website for that credit card. If it's an airline credit card, you could look at NerdWallet, compare, and then go somewhere else and actually start the relationship with that business, essentially bypassing the NerdWallet program. So I really think that was, NerdWallet saw that issue, and that was what created the membership program, so that if you're buying into their membership program, you have more stake into that product or into that membership, and therefore you're more invested into staying on that platform, using those resources, going through their portal to get the best offers. So those are all the products and services that they offer at this time. They also do have some advertising. They do produce content on YouTube and on their website in the form of articles that can then lead to advertising revenue, which they could in theory ramp up over time. So acquisitions. So let me see here. They made 5 acquisitions since 2016. So About Life, Fundera, Know Your Money, Fluence Technology, and On the Barrelhead, which is really just all the they've really just made acquisitions to bolster their technology that they had, whether it's their data that they're collecting, whether it's adding in Fundera, which was for small businesses. Know Your Money was a UK-based website, so they were really launched into that market. So they're really just tuck-ins to their existing business. They're not trying to completely jump into a new line of business, or take over a certain segment of business in order to start something from scratch. They're really just using their acquisitions as tuck-ins to the existing businesses, which is kind of what Netflix has done as well. It was really just Netflix. From one of our previous episodes, they have purchased companies in order to bolster their visual effects and just to get into the gaming segment, but they were really just to boost the performance of the business that was already running. It wasn't to really reinvent the wheel. So same with this business. They're not trying to really make a big splash with an acquisition. So the management, what I do like about this business is that Tim Chen is the chief executive officer, that the founder is still involved in this business. He's been there from the beginning, and he is still running this business. 2023 total compensation for Mr. Chen was $6.5 million, and a lot of it was in equity. So you can look at that as two different things, that the business is diluting the shareholders by providing $5 million to Mr. Chen in equity, or you can look at it as that he's taking less cash. He made $700,000 in cash and 5.8 in equity, and you can say, okay, he's being paid in equity, which gives him more incentive to grow the business or the stock. So you just kind of have to determine what you believe is more important, is being a shareholder and getting as much equity as possible out of the stock, or do you want the founder involved in this business and have motivation? So, not an egregious salary for such a small business. This is definitely a small cap stock, so I wouldn't expect to see a 10 million or 15 or 20 million dollar salary for the management. This is also a Silicon Valley company, which just when I say that, it just means that the thoughts of Silicon Valley sometimes are different from the rest of the country, and that there's definitely a bigger emphasis placed on the stock in Silicon Valley rather than cash, I would say. And the stock value is very important to Silicon Valley. So it's just interesting to research the differences between maybe a business that is set in the Midwest or the Southeast versus a business set in Silicon Valley. So the board of directors, right now they have 11 board of directors, so a good, healthy board. And Tim Chen is on the board of directors as the founder and CEO. Jake Gibson is still there. He was the co-founder. He is a director. And then they have a bunch of other directors. And you can find all of that information on my Substack, where I put all of my show notes, charts, graphs, numbers, financial ratios. All this information is on the Substack. The industry is the technology industry. They are primarily primarily only online. They're online on a website, and they have an app. So technology, fintech, personal finance, that is their space that they compete in. Who is their competition? They have a lot of competition. I'm not going to lie. It's like they have a good amount of competition, but again, you can look at this two different ways, that there are a lot of people competing and that all that competition is bad. There's low barriers to entry for someone else to start a website that compares credit cards, but they have been able to capture a lot of attention, that they have a large number of unique and recurring visitors to their website. So they have been able to succeed against all of this competition. So I consider the direct competition for this business YouTube, Bankrate, Credit Karma, Motley Fool, Personal Capital, Lending Tree, Investopedia. Basically, any website that provides financial information could be looked at as a competitor, and then any business that provides comparison for credit cards. So the Points Guy, Credit Karma, those things. Anything that offers financial products to consumers like credit cards can be considered direct competition. Indirect competitors, I would consider a lot of the banks. So these would be SoFi, Robinhood, Schwab, Quicken, maybe JP Morgan, or Bank of America, Wells Fargo. They're offering their own credit cards on their own websites. So you could go straight to those websites to buy their products and bypass NerdWallet. But on the other hand, that the big banks and just some of the smaller banks, they're offering these products. And so NerdWallet then partners with those banks. So it's a little bit of a competition, but also they need them in order to survive in the marketplace there. So also, I should mention that competition, part of the business is just capturing the attention of the consumer. That is part of their business, that they need to have as many eyeballs on their website, on their platform as possible. So indirect competition could be anything that takes away the attention from NerdWallet. So streaming, we mentioned Netflix, gaming, outdoor activities, movies, just anything that can keep the consumer from visiting the NerdWallet website would be something that could be competition. What is their moat? Well, I don't really see a direct moat for this business, but I see a few indirect moats. Again, they have been able to capture that attention of the consumer, which is an art that doesn't just happen by accident, or it's a very competitive, informational marketplace out there. So the fact that they have been able to continue to get people to visit their website and purchase their products and grow their revenue does signal to me that they know what they are doing in the content space, and that they are able to provide a lot of great content to their consumers. And as long as they do that and maybe have a finely tuned strategy, as long as they can keep delivering that valuable financial information to their consumers, that they're going to have a customer base right there, as well as if they can continue to expand the product line of the business, small businesses, travel resources, just continue to add in different sections, then it really will be more of a one-stop shop place for your financial health. If you're plugging in your bank account and you're tracking your spending and you're getting your credit score through them, then that could really be a moat for this business. But there are a lot of other services that do primarily almost the same thing, if not the exact same thing. So I don't see them as having a particularly a moat that just can't be replicated. There's also low barriers to entry to this particular business. So anybody can start a website and can start posting information about credit cards on there, or what savings accounts they think are the best. So there's more and more competition that will come over time, but the fact that they have been able to capture so much attention for their business does tell me that they will be successful in that regard going forward. All right, now let's jump into the second half of this show, which is all about the stock. Let's get to the good stuff. We learned about the business. Now, is the stock worth buying? Is it a good value? What do we know about this business? So we have to start with Tim Chen. So he is the founder, the CEO of this business, and he currently has a 42% stake in the business as far as we currently know. So that is a huge stake in this business. So he has a lot of incentive to grow this business over time going forward. He's very invested into this business, and that also tells me that maybe the large financial institutions, Vanguard, BlackRock, Schwab, State Street, all the really large hedge funds and just stock funds have not bought into this company, because usually what you'll see happen is when the stock takes a dramatic increase, goes from being a small cap to a large cap to a mega cap, the institutional ownership of that stock really dramatically increases over time. But I like that he controls this business, that he pretty much has full control of this business. If the board were to try to do anything to him, he could remove board members and have them replaced with his own people. So if you like him, if you like his leadership and how he's led this company to this point, great. And if you believe in the future of his leadership for this business, that's great. If you don't like him, then I would not invest into this stock. So in 2023, total shares outstanding was 770 million shares. So that's a healthy number of shares outstanding for this business. I've seen crazier numbers, but I would like to see that a little bit lower for the size of this business. And yearly shares issued is only 76,000. So that's not a huge number. For 2023, they issued 77,000 shares nearly. So not a huge number of shares that they are issuing each year, which is good. That means there's not a lot of dilution going on. The float is 38 million shares. Institutional ownership right now I have it listed as 67% for this stock. Insider ownership right now, beyond this is separate from Mr. Chen, is 5.8%. Percent of float held by institutions, 71%. Number of institutions holding the stock is 160 institutions. So that is so there are funds that are invested into the stock, and that does make sense because it's probably a part of some indexes, some small cap fund indexes, some small cap, value cap, just those type of index funds that are holding this stock. So top funds, the names are the T. Rowe Price Small Cap Value, Vanguard Total Stock Market Index, Vanguard Small Cap Index, iShares Russell 2000, which is usually the small cap ETF, Fidelity, T. Rowe Price, Vanguard, and more Fidelity. So a lot of small cap value ETFs, funds holding this stock. Top institutional holders is Innovius Capital Management, which I have actually not heard of. That's a first that I've heard of that business before. They hold the most, 75 million shares. Vanguard is next with 58 million. FMR Institution, 51 million. T. Rowe Price, BlackRock, and the list goes down from there. So there is a lot of institutional ownership of this business. So I do like to see that, because those are the whales that could come in and really drive the price of this stock higher. Does this stock pay employees in stock options or RSUs? Yes, they do. So shareholders are being diluted a little bit as you continue to hold the stock, but that's not uncommon with a growth stock. If you look at NerdWallet as really a business that's small, that's really trying to grow that revenue dramatically year over year, you're probably going to see them issue more stock options, more stock, trying to continue to raise money for this business. So right now, the valuation, the market cap of this business is $830 million. So less than $1 billion, less than $1 billion valuation for this business. The stock price is $10.50 per share. The all-time high was that initial IPO day, which was $28 a share, and the all-time low stock price is $7.23. So they are coming close to that $7.23 all-time low. And if you go to the Harness Money Substack, I've got some nice charts that illustrate the stock price, the revenue, the net income. Does the business pay a dividend? No, the business does not pay a dividend. It is pretty much in growth mode for the time being. Let's talk about the financial statements, because that really is what correlates directly to the stock. So why is it valued at less than $1 billion a share? And that is because in 2023, they had revenue of around $600 million. So $600 million, 2022, $538 million, in 2021, $379 million, in 2020, $245 million. So they have not cracked $1 billion yet in revenue. And I really look at that as, it just in my mind, being able to reach $1 billion in annual revenue just hits a mark that says, okay, there's really a market for this business and the products that they are providing to the consumers. And so I do like to see that every single year over year, they are increasing that revenue at a steady clip. Isn't that in the last 5 years, going back 5+ years, they have not had a decrease in revenue. They have had an increase. And sometimes from 2021 to 2022, they increased the revenue 36%. In 2022 to 2023, they increased 30%. So they have had some nice years of really increasing the revenue of this business and just trying to be as successful as possible. So for this business to really take off, they're going to have to keep doing that on a consistent basis for a few number of years. And I wonder, going into a recession, it seems like they haven't really faced a massive recession. Yes, they did go through COVID, which was a big recession, but that was kind of unlike anything we've had previously. They haven't really been through a traditional, as if there is any type of traditional market pullback or recession. I don't think 2008 was traditional, but it was a serious pullback. And then 9/11 wasn't necessarily 99, and then 2001, that wasn't necessarily a recession. But the question is, if the United States goes into a lull or a slowdown, how does that really impact this business? Will more people be shopping for credit cards? Will more people be trying to get financial information, or will people just pull back spending altogether? Will people decide, maybe we shouldn't spend this money. Maybe we don't need all of these credit cards or these financial services and pull back on their services. That's what I'm not sure about with this business. And I have a question mark is if there is a pullback, does it hit this business harder than other businesses, or does this business really get a boost from the consumers? I'm not quite sure just yet. So as of right now, what I could find was that all of the revenue comes from the domestic marketplace. They are international. They do have some international operations, like I mentioned, the UK, the European Union, but they don't. I couldn't find any numbers around how much is being made from those segments. So I think that is really the opportunity, is that they really need to get their product into the international market, into Japan, the UK, South Korea, those places, all the different worldwide markets, to really make this a successful mid-cap or large cap business. So again, on the Substack, I have the revenue charts, the net income charts. So net income for this business, this is where it gets a little bit dicey. So in 2020, they actually showed a profit of 5.3 million, but then in 2021, remember in 2021 that they went public, they raised money, and that is really when they started spending. So it's negative. In 2021, their net income was negative 42.5 million. In 2022, it was negative 10.2 million. And in 2023, this past year, it was negative 11.8 million bucks. So the last 3 years, they have had a negative net income. And I don't know, it's not looking great. I don't know if they are going to get to profitability anytime soon. I mean, it's good. I like seeing that the revenue is increasing, but I don't know if I want to invest in a business at the moment that has a negative net income, unless it was really dramatically increasing their revenue, maybe $1 billion a year, something doubling their revenue per year. Especially at this size. This is a small business. It just becomes harder. The larger you get, just the more difficult it is to increase your revenue. So seeing a negative number right now, not great. And of course, correlated to that are the expenses. So every single year for the past 5 years, expenses have gone up for this business. So in 2023, it was $599 million in expenses. 2022 was 538 million. 2021 was 379 million, and 2020 was 245 million. So just as revenue has dramatically increased for this business, so have their expenses. So they're really going to have to, again, that's why they need to dramatically increase revenue year over year. They're going to have to do this for a long period of time. It's really just to outpace the expenses that are coming. But some businesses have been able to did that for decades. Amazon is the one that's notorious for, they really they spent everything they had for many, many years before they were profitable. And now that they are profitable, they're crushing it. They're killing the market. So it can happen that businesses are unprofitable for a long time. And that seems to be a playbook of Silicon Valley, is that Silicon Valley seemed to be that they were okay taking losses as long as they were showing growth year after year. But I think that the overall market sentiment now is that companies need to be profitable for investors to really get behind them and put a lot of money into them. So the balance sheet in 2023, they had total assets of 446 million. In operating cash flow, they had $72 million in operating cash flow. So not too bad. I don't see anything horrible with that. What I do like to see about this business, one of the numbers is total long-term debt was at zero. They were listing $0 of total long-term debt. So they're not being crushed by a loan payment or having to grow the business in order to service the debt in a big way. So I do like to see that, is that they're not going crazy, going to a bank and trying to spend their way out of a hole that they've dug themselves. But they do have total liabilities of $67 million. So they do have liabilities on the books for sure. Earnings per share is negative 0.16. So, and then price to earnings ratio is a negative 94. So the financial ratios for this business do not look great. It was hard to compare this business to other businesses because there's not very many publicly traded stocks similar to this business. Even the other fintech businesses are more banks, or if you're looking at SoFi or Robinhood, those are investment platforms. They're not really affiliate marketing businesses. So it was kind of a little bit difficult to find direct competition for this business that was actually public. There's plenty of websites, again, like I mentioned, the Points Guy, or online resources that are very similar that are competing, but those aren't their own standalone public business. So that was just hard to compare some of the ratios. But for all of those ratios, visit the Substack page that I have. And now let's get to my verdict. It's time for the verdict of this business. Am I a bull or am I a bear? So let's start with what could go right, potential success. What could go right for this business? And what could go right is that they just continue to gain popularity. If they have visitors coming to their site week after week, month after month, year over year, then they will be able to survive because they already have products that people want. Credit cards are constantly coming out with new offers and with new information that people need to consume. I think the other trend is credit card points. I think more and more people are getting savvy with the credit card points game, and they are jumping on that bandwagon and realizing that if they have a credit card, they can build these points that can then lead to cash back, or that can lead to traveling to Disney or going over to Europe and traveling because of your points. And so I think more and more people will be exploring that particular segment. But there's also, I'm sure, a lot of churn. I feel like people jump into it, they get their credit cards, and then they don't go back. They get the points that they need, and they don't keep doing it time after time after time. As you get more and more financially healthy, you probably are looking less and less at the credit card points that you are accumulating. And it also, every time you sign up for a credit card, it hurts your credit score a little bit. And so chasing those credit card points over time just becomes very complicated. It becomes very time consuming, and you really have to stay up with that information, which there can be an audience for that for sure, but it's very niche audience. And so that's why NerdWallet seems to really have branched out and is trying to reach just as many consumers as possible holistically with their basic financial information like your credit score or tracking your net worth. But that is an opportunity if they can go deeper, have the best tools in that particular marketplace. That will give them customers. Customers will find their products, and then it will be sticky. If you're tracking your spending, or you're tracking your credit cards, or if you could do your taxes through NerdWallet, that would be huge. I feel like you could take on the Intuits of the world. So there are some areas I feel like that NerdWallet has for expansion. And of course, like I mentioned, they're going to do whatever they can to expand their membership program. The more members that they get, those are much stickier customers, much more engaged customers. If they can grow that, they will be successful. That will lead to a lot more profits, I feel like, on their bottom line, if they could really grow that, as well as internationally. If they can capture Europe, some of Asia, maybe South America, even if that's even possible, they could go after those consumers and start monetizing international consumers. That could very well be the path forward for this business. Let's talk about potential failure for this business. What could go wrong? Well, the primary is that visitors just stop visiting their platform, their app, or their website. That people stop finding value in their products, and they just slowly die off and don't keep using their products. But That's not most likely not going to happen anytime soon. They've proven that this far. They've been in business for many, many years now, and people are still visiting their website. Their traffic is still growing, but the products that they are offering it's also changing, but they don't have any proprietary products. So that is, to me, another potential failure for this business. If there was a big credit card company like Chase or maybe Capital One, if there was some credit card company that was for some reason withholding their offers from this business, or if multiple companies did that and stopped providing their offers to NerdWallet, then that could be spell disaster for this business. The other one is that other blogs, other websites, other financial services just take users away from their business and just take away the customers of this business. So any outside factors affecting this business, pretty much the macro economy of the world economy. If there's a slowdown, I don't know how that would primarily affect this business right here. I should have mentioned another one. Going back up to their potential success, what could go right for this business is they do have advertising. So the fact that people are coming to find out the latest credit card offers or savings account bank offers, that could lead to advertising. If NerdWallet was able to really build out their content, maybe a YouTube channel, podcast, their own website, and have this omni media, have a bunch of different platforms where they are producing content, they could potentially leverage that as an advertising platform so that they get money from advertisers. The advertisers put it on their website, put their products, their advertisements on their website, and NerdWallet gets a fee for that advertising. If they could grow that segment and really build that out, that could be another line of revenue that could be a forever line of revenue for this business. So what is my final verdict on the business? I'm just less interested in this business. Now, even though this is a small cap stock, which is, I do like to look for small cap stocks because I want to know, is this something that could double or triple or 10x in value over the upcoming years? And this does fall into that category, which is a small cap. But for me, the fact that it's just not profitable, the business isn't profitable, I'm not sold on their business model. I just don't love that they don't have a proprietary product that they are offering their consumers, that they are always going to be relying on these kickbacks from these companies. One thing I've learned doing business is that if you are doing business to business, their business owners are very savvy with how they pay out their vendors. So if NerdWallet is a vendor, they're collecting a fee from JP Morgan Chase. JP Morgan Chase could say, you know what, we're not going to pay you. We're going to put this into our accounts payable, and we're going to manage that and not pay you for a certain period of time because they're trying to manage their own cash levels. That I don't like. I don't like the fact that this business, it's small, it's relying on business-to-business relationships, and that they don't have a proprietary product. I want to see a Tesla, or I wish they would be the credit card provider or the pipes of the credit card rather than just the end of the pipeline where they're getting customers into their funnel and then taking a fee off this business. And it's also small cap, so that goes to the stock, which is they're small cap. They have not produced net income yet, so I'm skeptical. Are they going to be profitable? Are they going to be able to return shareholders money anytime soon? I don't know. I definitely don't see them paying a dividend anytime soon, for sure. And is it really that much of a growth stock? I don't see the revenue increasing. Even though they're doing a good job of increasing revenue, I don't see it increasing dramatically anytime soon. And that makes me question whether or not the business will be profitable anytime soon. And then also the NerdWallet Plus, I'm not convinced that is going to be a huge success. I think it could bolster the loyalty of the consumers that they do have, but I'm not sure if that is really the stickiest way to grow this business. I just have reservations about that. And then, but it could be a good way to gamify if they could somehow get people to stick in the app using the membership program. Maybe that's a way to make that a success. But I'm just not completely sold on the membership program. I just don't know if it added as much value as I would like to see for a membership program. So I would say I am a tepid bull on this business, that I'm confident the business is going to continue to grow, will continue to grow their revenue, but not at a super fast rate anytime soon. But it is a low value. So if you're looking for a value stock, especially right now, with being under $1 billion, almost close to their all-time low in price, you could just buy and hold for the next 10 years, and that might serve you very well. You could buy a lot of shares right now at a cheap price and hold for another 10 years. And who knows, they could really find their footing and really start to dramatically increase that revenue, and you would be holding a lot of shares that could dramatically increase in value. So there is a way to play this trade or this stock. You could also buy long call options on this stock and just hold and really see if it grows over time. So I'm a tepid bull just because I just don't see it growing that fast, and it's just not positive. The net income's not positive. So right now, I would give this a rating of a 4 on the rating scale. So good, but not great, I would say, for this business. But it was very interesting to see a Silicon Valley stock that's not one that you hear of very often. And that is all I've got for the show today. Thank you for watching. Again, I will be back next week, every single week. I will do my very best to break down a stock from beginning to end. And thank you all for watching. And remember to make good money choices. Till next time.